Hi, everyone, and welcome to OnPay's webinar today, Benefits 101 for Employers. You'll come away from this session with a high-level understanding of employee benefits to make informed decisions for your business. We're super excited to have you join us today. Let's meet your presenters. My name is Kara Rajapaksa. You can just call me Kara, and I'll be your moderator. I work on OnPay's partner development team, and I'm certified through the American Payroll Association.
And my name is Jordan Perry. I'm the Benefits Operations Manager here at OnPay, and I have more than 10 years experience in benefits and payroll.
Now, we've got a lot to cover together, so we're going to start with some must-haves like workers' compensation, mandatory short-term disability, and how to make sure you're staying compliant.
And then we'll talk about the benefits most commonly offered, as well as which ones are most sought after by employees, as well as additional perks and benefits you could be offering. We'll also talk about how you can go about offering these benefits to your employees if you're just getting started.
Now, before we begin, don't forget to ask your questions. There's a questions section of the GoToWebinar panel. Go ahead and find it here. Feel free, let us know where you're dialing in from. I'm actually going to take a look. Both myself and Jordan, everyone else on this call, except for one of our panelists at the end of this call, dialing in from Atlanta, Georgia. We've got someone from Rochester, New York. Oh, perfect. I'm seeing Ohio in the comments, Seattle, Washington. So feel free, give us a shout out. Let us know where you're dialing in from. And that's also where you're going to go if you have questions throughout this webinar. We'll get to many as we can, and we're going to take questions at the end of our session today. Oh, nice. Baltimore, seeing a few other places pop up too. All right, let's begin. When it comes to offering benefits, we're going to start first about talking what you're required to offer to your employees as an employer. As an employer, you're required to provide certain benefits to all of your employees, and that does include things like time off to do military service or go to jury duty. And you also have to make sure to withhold FICA taxes to pay into their future retirement or disability benefits. And as your company grows, there are federal laws you'll need to comply with as well. You'll also need to comply with all workers' compensation and short-term disability insurance requirements for your specific state. So let's get into a little bit more about the last two on the list, workers' compensation and short-term disability. So Jordan, can you tell us a little bit more about workers' compensation?
Sure. Workers' compensation protects both the employees and the employers when someone gets sick or injured on the job. Right now, Texas is the only state where workers' compensation is voluntary, although it is still highly recommended. Requirements vary from state to state, so be sure to check out the article that outlines the workers' compensation requirements in all 50 states.
And Jordan, it does seem from what I've seen that pay-as-you-go workers' comp policy or plans is what a lot of businesses have been leaning towards lately. Can you go over the difference between a pay-as-you-go policy and a more traditional workers' comp policy?
Well, traditional policies require an upfront deposit plus monthly payments to cover your estimated cost of liability. These costs will depend on the size of your business as well as the industry that you're in. Then, at the end of the policy period, there's an audit to see how accurate that initial estimate was. If it missed the mark, you might end up having to come up with additional funds for your workers' comp coverage, or you may get a refund. But with pay-as-you-go plans, there is no upfront deposit required. Costs are actually calculated based on the actual payroll data as opposed to estimates.
Thanks, Jordan. And keep in mind, too, if you're in one of the 4 states listed on the screen that purchase workers' comp from a state agency, you will only qualify for a traditional policy rather than a pay-as-you-go plan. All right, Jordan, what do employers need to know about short-term disability?
Well, state disability insurance or short-term disability coverage helps employees during off-the-job temporary disability, such as injury, illness, or pregnancy. These policies typically offer leave benefits and income replacement for the employee. And they're mandated in several states, including California, Hawaii, New York, New Jersey, and Rhode Island. Companies with employees performing work in these states must either provide or facilitate the procurement of short-term disability insurance for those employees. The rules for how they work vary from state to state. So, for example, in California, short-term disability insurance is managed through the state directly, whereas in New York, an employer must obtain private coverage or purchase coverage through the state fund to meet the obligation. If you're not in one of these states, employers can still offer short-term disability as a benefit, and you even have the option for it to be either employee or employer paid.
Really good to know, especially as income or job loss due to a short or long-term disability can be absolutely devastating to an employee financially. If I'm right, it seems that providing disability insurance to employees, it can be really valuable. And also, I think is it at a relatively low cost to the employer, or can it be?
It absolutely can be.
All right, well, let's talk about why employers should offer benefits, how it can help your employees, you, and your business. Many small business owners mistakenly believe they can't afford to offer benefits, but offer the right benefits, and your business may just jumpstart its growth. When you offer your employees benefits, there are a number of advantages that come with it. It can help you attract and retain talent while decreasing turnover, which can save you money in the long run. 75% of employees say they are more likely to stay with an employer because of their benefits programs. And turnover can cost employers as much as double an employee's annual salary.
According to Glassdoor, benefits are the second most important factor when looking for a job, right behind salary. About 60% of people report that benefits and perks are a major factor in considering whether to accept a job offer or not. And 80% of employees would choose additional benefits over a pay raise. Not to mention the tax credits you can earn and how certain benefits can decrease payroll taxes for both you and your employees.
And offering benefits also helps increase employee job satisfaction, which leads to higher productivity and an increase in sales and revenue. We're total nerds here, so let's talk about the numbers. And when you offer benefits, we already discussed it's making your employees feel more valued and appreciated. When employees are satisfied in the workplace, leads to better performance and productivity, increase in sales and revenue, and there's studies to back us up here. So several studies showing that job satisfaction increases productivity. One such study from the Harvard Business Review showed an average of 31% more productivity and 37% higher sales when employees are happy or satisfied. So, Jordan, what are the most common benefits that employers offer?
According to our 2020 State of Small Business survey, the top two most commonly offered benefits are PTO or vacation time and health insurance. These are followed by retirement plans, paid parental leave, dental, vision, and life insurance.
And the benefits we don't see offered as much: HSA and FSA plans, commuter benefits, and telecommuting or remote work options. Although I have to say, this has already changed quite significantly through COVID-19.
And this doesn't look too different from the benefits employees want the most, with health insurance topping the list, followed closely by PTO or vacation time and retirement plans.
Following these top three, employees are also looking for vision, dental, and life insurance, paid parental leave, and lastly, HSA and FSA plans. So let's talk about the benefits employees want most in a little more detail. We know that health insurance topped both the list of benefits sought after the most and the benefits offered most often. So generally, employers with 50 or more employees are required to offer health insurance. But even if you're not required, keep in mind that 56% of employees consider health insurance to be a key factor in determining whether they'll stay at their job. We've got studies to back that up too, one from the Society for Human Resource Management. So it's definitely worth considering if you'd like to keep turnover at a minimum. And you're probably thinking at this point, hold on, Kara, stop. What is that going to cost me? Jordan, what is the average annual premium for health insurance?
Well, in 2016, the average annual premiums for employer-sponsored health insurance plans were a little over $6,400 annually for a single coverage and $18,000 annually for family coverage, according to Kaiser's survey for employer-sponsored health benefits. Please keep in mind that the cost of coverage for your company will be determined by the plans you select to offer, where you are located, and the demographics of your employees. Also, you may be able to deduct health insurance premiums that you pay as the business owner. Talk to your tax attorney or financial advisor to see if you're eligible for any savings. And remember, any plan you offer to your employees, you can add yourself to as well.
Nice perks there. And paid time off is also a benefit employees often want. Paid time off can include vacation, sick days, and holidays. Now, if you're creating your PTO vacation policy, you might ask yourself, how long will employees be required to work before they begin to earn time off? Is vacation solely for full-time employees only, or will you offer vacation time for part-timers too? Will employees accrue time or be given a lump sum at the beginning of the year? And will you reward employees that stay with you for a few years with additional time off?
You will also need to consider whether a use or lose it policy or carryover policy is best for your business and your employees. Use or lose it vacation encourages employees to take all their vacation every year, while carryover policies offer a little bit more flexibility for employees if they need to take a little longer time away from work.
Something else to consider, state law may require you to pay employees for unused accrued vacation time if they quit or are terminated. So, great idea to do your research about the requirements in your state so you're ready when it happens.
FMLA already requires that employers with 50 or more employees provide 12 weeks of unpaid leave and job protection to employees who need time away to take care of those family members or themselves during a serious illness, injury, or after the birth of a child. However, there are some states that require paid leave options as well. In the resources we'll share with you at the end of the presentation, we've included state-by-state paid family leave requirements, how to create a PTO policy, and much more.
And also be sure, I didn't mention this at the beginning, check out our handout section. We've got a copy of the slide deck with those resources as well. And we know that employees consider retirement plans an attractive benefit to say the least. Jordan, can you break down for us one of the most common options?
Absolutely. Let's go over to the 401k, which is one of the most common plans out there. A 401k is a qualified retirement plan. That means it's eligible for special tax benefits under IRS guidelines. Employees can invest a portion of their salary up to an annual limit. Employers have the option to match employee contributions, but they're not required to. About 90% of employers match employee contributions, and these contributions are typically between 3 to 5% of the employee's salary. The contributions are most often invested in a variety of mutual funds. Since 401k contributions are made with pre-tax dollars, they reduce your employee's gross income, thus lowering the payroll taxes for both you and your employees. Currently, there are no states that require employers to offer a specific type of retirement plan, but California, Illinois, and Oregon have established state-sponsored programs for businesses to offer some type of plan to their employees.
Thanks, Jordan. Now, there are other benefits you can offer your employees outside of what we've just mentioned that you may not have thought about before. You can offer paid time off for volunteering, which is a nice way to strengthen team bonds and boost an employee's image of their employer. OnPay, just to use us as an example, we offer our employees one paid day off each year for this purpose, in addition to employer-sponsored team volunteering to give back to the community. Now, it's no surprise that with COVID-19, we're also seeing an increase in work from home benefits, and a whopping 60% of employers offer this to employees. It's a way to prevent employee burnout, and this flexibility comes with higher employee job satisfaction. Or, if possible, offer tuition reimbursement to your employees. Doing so reduces employee turnover, brings in knowledgeable workers to your business, and best of all, is tax-free under a certain amount.
Now, if you're ready to find out more about adding benefits to your business, OnPay can help. We offer everything from health insurance to 401ks to workers' compensation plans for our clients. And our in-house team of licensed agents can take the guesswork out of selecting a good plan. They'll help narrow down the best choices for your business based on what you're looking for, as well as what you're looking to spend, and even handle all the paperwork. Just go to onpay.com/benefits to get started.
Onpay.com/benefits is the place to go. Thank you, Jordan. And as mentioned, here's a whole list of helpful resources on our website where you can learn more about any of the benefits we talked about today. Check out that handout section in GoToWebinar for more details. We'll also be sending up a follow-up reminder too. And as promised as well, you've got questions, he's got answers. I would like to introduce Paul Forey, our Director of Insurance. He's a licensed insurance broker with more than 30 years of experience in benefits and insurance for small businesses specifically, and has a wealth of knowledge. And we always like to joke at the office, if you have an insurance question, better call Paul. So feel free, ask those questions in the questions panel of GoToWebinar if you haven't already, but we are going to start with a few common ones. Paul, can you say hi to everyone?
Hello, everyone, and thank you, Kara and Jordan. Well done.
Perfect. All right, well, let's start with one of our commonly asked questions. All right, Paul, how many employees do you need to establish a group health plan?
Well, Kara, it can vary by state, but the bottom line is we really just need one W-2 employee. The only time we run into difficulty is when the only person seeking coverage is the owner. So we cannot write an owner-only group, but if we have one other full-time W-2 employee, they could be added to the group, if you will. So we could just write that one employee. And of course, if the owner at that point is interested in joining, we could enroll two people.
Perfect. Nice. Good to know. Thank you. Next question up. How much does health insurance cost?
Well, Jordan touched on this earlier. It really varies, again, by the location of the company, certainly where the business is based, also the demographics of their employees. So usually in the very early stages, we like to secure an employee census of the full-time employees' dates of birth so that we can then provide some quotes and look at various plans that are offered to fit various budgets.
All right. And then final question before we take questions from the audience, Paul, are there any other requirements to establishing a group health plan?
Yes, Kara, great question. Most, the carriers are willing to establish a small group plan as long as there's a couple of basic requirements met. And those would be where the company is going to enroll at least 50% of the full-time eligible employees. And of course, the company would have to contribute at least 50% of the single cost for the employee. Certainly they can pay more depending on their industry, et cetera, but those are the minimum requirements.
Perfect. And I think this encapsulates everything well. Trevor wanted to give you a shout out, Paul. Paul rocks, and I agree. So let's tackle some questions. Just as a reminder for everyone, though, if you need specific quotes, feel free, go to onpay.com/benefits. First question from Sobia. Can you please talk more about the requirement of short-term disability in California?
Sure. Jordan, you want to jump in? I'll be happy to start. I mean, with short-term disability in California, it is a requirement. You actually have the coverage as a business, and the premium is paid as part of your quarterly tax returns that we file on your behalf. Jordan, anything to add?
Yeah, so you automatically, in California and some of these other states, you automatically have coverage for short-term disability as soon as you've applied for your state tax identification number. And as we were saying earlier, it's all managed through the state. So if an employee has a claim, they would just go to the state to get that claim done. So in California, it's through the EDD. In New York, we like to mention that because it's a little bit different because you actually have to go through a private insurance carrier as opposed to going to the state and being automatically enrolled in that coverage. There is a state fund in New York, but that's the subtle differences between the states as far as short-term disability is concerned.
All right. Well, next question comes from Casey. How do I move the employee paid deductions to pre-tax versus post as they are right now?
Sure. So in order to do that, what you're doing is really utilizing Section 125 of the IRS code, and there is a plan document that needs to be, in essence, created and adopted by the company. And in that document, quite frankly, it is allowing employee contributions to group benefit plans, medical, dental, vision, to be done pre-tax out of their paycheck. So to answer your question, you just need a Section 125 document in place. We use a third-party administrator that focuses on small business. It's a one-time fee, and it's quite frankly very inexpensive. And by making the deductions pre-tax, certainly the employees are saving payroll tax dollars, and of course the employer saves the FICA match. So in most cases, it literally pays for itself.
Nice. And Paul, quick follow-up from Casey on that point. Do you file that document with the state?
No, you just, in the old days, or if you have more than 100 employees, you have to. But under 100 now, quite frankly, you're just having that plan document, adopting it as a company, keeping it for safekeeping, and in case anyone were to inquire in an audit situation, hey, why did you take these deductions pre-tax? Did you have a document that allowed this? You pull out the document and you're good to go.
Sounds good. And then I have a question from, I'm going to kind of paraphrase a little bit from both Bill and Christine, because they're both asking questions about part-time employee eligibility. So more specifically, what if my employees are all part-time? Would we still be able to get plans? Does full-time status make a difference for health or dental insurance plans and coverages?
And the answer is yes. The carriers, again, kind of have a requirement, if you will, where they're looking to consider an employee full-time if they average 30 hours per week or more. Now, again, they're not going to split hairs if it's 28, 29, et cetera, but they have found that when an employee is part-time, working, 12 or 16 hours, they just can't afford the employee benefit cost. Now, things are different if the employer is paying the entire cost, number one, but the carrier is still going to have the requirement that they're looking for employees to be eligible at 30 hours a week or more. If someone's employment is part-time, we may want to look at a different type of employee benefit that maybe not a full major medical contract, but something that would provide the employees, say, a teledoc service, and there are some other options.
All right, thank you. And then I see one question left. I'm going to ask Paul this in a moment, but I did want to encourage everyone, feel free. If you have outstanding questions, we want to make sure that we answer them for you. So we still have enough time if you want to get your questions in real quick. But question from Norman, and this may be something we'd have to direct to AP Indigo, but I'll ask it. Can pay-as-you-go workers' comp exclude the owner in the state of Florida?
Almost all states, the owners can be included or excluded. Certainly depends on the type or entity and the way it's structured. So if it, for example, is a C Corp, everyone is an employee, even the owner, and therefore they would legally, choose to exclude themselves if they wanted. If it's a partner or sole proprietor, so they're not an employee, they're not covered under workers' comp, and they could choose to be legally included and pay the premium. So to answer the question is yes, we would work with our partner AP Indigo, but in almost all states, you'll see that it is acceptable for the owners to include or exclude depending on how the business is structured.
Nice. And I'm seeing a few more questions pop up, which I love. It makes it more interactive. Follow-up question from Norman. Does the employer have the right to challenge a work comp carrier that imputes independent contractors as employees for workers' comp benefit purposes?
I think, in today's world, you can challenge anything. To be honest with you, may be expensive, but I think if you look in your workers' comp contract policy, there are provisions in there for you to challenge, a claim that was denied or a claim that was paid or an audit. I think there are provisions in there. I think the key is that, the carrier includes contractors usually at audit time because as a contractor, they're not paying, taxes, payroll taxes. So we're not reporting them to AP Indigo so that they're charged a work comp premium. So when the audit gets done and the auditor is on site and sees that there's contractors paid, quite frankly, they just want to make sure the business has secured a copy of the contractor's work comp policy, a certificate of coverage from the contractor. If those can be produced, they're not included in the audit. If they cannot be, then that's when usually the contractors are added to the audit and the employer has to then pay for it. And the point is that, with the carrier, they know if there's a claim, chances are they're going to end up, paying that claim and they never collected premium. So that's really what the audit is all about and how a contractor can be or can, not be calculated in the calculation. So if you have contractors, the best thing you can do is make sure that they provide you with a certificate of insurance.
All right, and we have time for two final questions, and they're surrounding the same subject of workman's comp. Question from Eric out in Texas: pros and cons, Paul, to having or not having workers' comp in that state.
Um, again, I think the last number I saw was about 65 or 8%, even though it's voluntary in the state of Texas, have it. I think for the pro would be to take care of your employee clearly. So, you may not have health insurance. So if something were to happen to the employee on the job, at least workers' comp policy would pay to take care of the employee's injury, if you will, as well as wages. The downside is, you're going to pay a premium, for that, of course. And I think a lot of times people forget workers' comp does in fact protect the employer from being, sued, a negligent suit. So if an employee is hurt on the job, a lot of times they'll try to collect a claim, and then they may try to sue the employer for something that was negligent, which created the accident, if you will. And so that's really the protection of having a workers' comp policy, is the employer does get that, some degree of protection from being sued from the employee.
All right, and our final question coming from Bill: I was under the impression that pay-as-you-go is not an option in Massachusetts. Is that correct?
The option is based on the carrier. Um, most of the major carriers that our partner AP Intego works with, Hartford Travelers, Berkshire Hathaway, et cetera, they allow a billing process known as pay-as-you-go, just because A, they're a big company, B, the payroll companies like OnPay have been tried and proven that, our data is good, the process works, et cetera. So the only time that we run into a situation in any state, quite frankly, is if we don't use one of the major carriers that allows a pay-as-you-go billing method. So if someone maybe has to go through the state fund because their business is hazardous, or they have an insurance carrier that they work with that doesn't allow pay-as-you-go billing, then that would be the only time that would work.
Great. Well, I really appreciate your time, Paul, in answering these questions, Jordan in presenting the material. I'm going to drop a link in the chat right now. Don't worry, we're going to follow up with you by email as well if you'd like to schedule a time to speak with someone one-on-one about benefits coverage. So I just sent that out in the chat section. It's another part of the panel and GoToWebinar, so I'm just going to wait a beat, make sure everyone has access. So navigate to chat. You can click on that link. It'll open up a new tab in your web browser. But take a look for your inbox and email from OnPay. But on behalf of OnPay, thanks everyone for your time, and have a great rest of your afternoon.